Okay, chapter 24, we're talking even more about our fixed costs and how we allocate them and the importance of that. And so when we have direct costs like the materials and labor, and those are very easy to assign to a specific product. But when we get to the overhead costs, we allocate those, and so we're estimating on those. But it's very important. We need to get this right. If we are just making a wild guess and putting it in there, that number is what we base our pricing decisions on. And so if we're not pricing our product right, then we are either losing business because we're pricing it too high, or we're not maximizing the profit we can because we're pricing it too low. And if you don't have a lot of competition, it's not as critical. I mean, it's always critical. You need to know how to do this. I just realized you couldn't even read that. Need to get it right. But the more competitive of an industry you're in, the more important it is to get this number right. So there's several different ways to do this. So what we've looked at so far is a single plant-wide predetermined rate, okay? And so this is the traditional or the kind of old-fashioned way. It's very simple, and we've looked at this before. The first thing you do is estimate what the total overhead costs are going to be. And then 2, you estimate the volume of your activity base, whatever that is. And we looked at this in the last chapter. That's your cost driver. It's supposed to be the thing that's driving your cost. And so we've looked at machine hour, we've looked at direct labor hours, we've looked at direct labor dollars. Those are some of the if you see 40% of direct labor costs, that's direct labor dollars. So those are the common one we've seen. And then you kind of come up with that predetermined rate. The estimated cost divided by the activity base gives you a rate. And then you allocate overhead using that rate based on actual volume. So you apply that rate to the actual volume, and that's of that cost driver. So the actual number of machine hours or direct labor dollars. And that's kind of how we looked at it before. This is an example out of the book, and in this one I think they were allocating it based on 40% of direct labor cost, direct labor dollars. So they this is kind of a baseline for you. And so they said, here's for the standard model, premium model, what we think the total overhead's going to be, how many units we're going to make, and so there's the manufacturing cost. So this would be like your direct costs and that kind of stuff. This one actually, they're just based it on number of units. Sorry, that's all they did. So then they just did manufacturing per unit. And then here's how much they ended up with after the direct materials and the direct labor. So that's our baseline at the standard rate. A more exact way to do it, because you've got a lot of different costs going into there, and they don't all behave the same way, and they're not all driven by the same things. So in this example, we'll have multiple departments. And so let's say I break my process into the assembly department and the overhead department. So the assembly line is going to use machine hours because that's the thing that's driving the cost there. And the software department is going to use direct labor dollars because that's what's driving the cost there. So if we take this same example here but do it for 2 different departments, we have it like this. So the assembly department is estimating $800,000 in overhead. They're estimating a total of 20,000 machine hours. So they get this rate of $4 an hour. And so if they had 15,000 machine hours at the standard product and 5,000 for the Ford, this is how much they end up allocating. And then you do the same thing over here for the software department, but on this one they're basing it on direct labor cost. And so that's how they allocate it that way. So that's going to be a little more exact. And so what we see on this one, this was the first one we did, And if I just used a this is the new one. This is the one where I have the two different departments, assembly and software. This was the first one where I just had a single plant-wide rate. And you can see here that the standard model, that when and these costs don't change, these guys are the same. So but the overhead here has what's changed. So this one, the total cost per unit is a little more than what I had originally thought. And this one over here is a little bit less than what I had originally thought when I was just using a single plant-wide rate. So depending on my pricing, I'm probably not making as much money on the standard as I thought, and I'm making more money on the premium than I thought because the cost is lower. And then here's the difference. You can see I was $7 off on the premium model. And if I'm in a very competitive industry, that's a big difference right there. So let's just do a couple of that here. We're going to do a single and a multi-department on this one. So the Oatman Company manufactures two departments, mixing and packaging. And this one we're just going to use a single plant-wide rate. So we're going to calculate the predetermined overhead rate, and then we're going to determine the amount of overhead allocated in December. So the predetermined overhead rate is the budgeted fixed overhead, which is $810,000, divided by, they're using direct labor hours, and they are estimating 360,000 direct labor hours. And this is dollars. And so I get a rate of $2.25 per direct labor hour. So every time this job or this department incurs an hour, I allocate $2.25 of overhead to that job. In October, the company incurred 20,000 direct labor hours. So in October, I take the actual amount of my cost driver, which is 20,000 hours, times that predetermined overhead rate, which I just calculated as $2.25, and I get $45,000 is the amount of overhead that I allocated in October. So that's pretty simple. The next one says, all right, we're going to do this, except now they've refined this a little bit, and they've got two overhead cost pools, one for each department. So the mixing department is anticipating $510,000 in overhead based on direct labor hours, and they're anticipating 170,000 direct labor hours. So let's do mixing. So they are estimating $510,000 in overhead, and they are anticipating 170,000 hours. So they get a rate of $3 per direct labor hour. The packaging department is anticipating $300,000 in overhead, and they are going to use machine hours right here, and they are anticipating 40,000 machine hours. So their predetermined overhead rate will be $7.50 per machine hour. In October, the company incurred 38,000 in direct labor hours. In the mixing department, 38,000 hours. And the packaging department incurred 10,000 machine hours. So 38,000 times 3 means they are going to, 114,000, that comes out to over here. And 750 times 10,000 is $75,000 over here in the packaging department. And so if I put these two together, the total overhead that I'm allocating is $189,000 for the year. So that's going to be a more accurate number than if I had, that's for October. So that's a big difference. If this is supposed to be the same one, I had 45,000 over here, and now I have 189,000. That's a big difference right there. But generally, the two departments is going to be more accurate. We can make this even more detailed by using what's called activity-based costing. And so you break your whole operation into not just departments, but into specific activities. And then each activity can have its own cost driver. All right. So as an example, quality inspections would be an activity. Providing warranties, shipping, setup for machine production. Again, most of this is very manufacturing related, but it doesn't. This process can apply to other things as well. But machine usage, purchasing, and so different things are driving each of these costs. So it would be silly to use machine hours for service calls. Oops. I'm going to use the number of service calls for that one. That's what's driving that cost. And so each cost is driven by something else. So I have to, every time I change batches, I have to do a new setup on the machine, and that takes some time and it's some downtime. So I count that as an activity of itself. Purchase orders are what's driving my purchasing of raw materials. And so there's a whole bunch of these. So it takes a while to develop. It's a time-intensive process to develop, and you do have to revisit it once in a while. But once you've developed it, you're going to get much more accurate numbers, which again, it's, you can't run your business if you don't know exactly how much it costs you to make whatever it is you're making or do whatever it is you're doing. And so this is going to give you better information. So the 4 steps are identify all the different activities and then figure out what's the cost associated with those. Again, we're just focusing on the indirect costs here. Then to identify the allocation base. What's driving that? If it's a truck, if it's delivery, it might be miles. If it's machining, it's probably machine hours. If it's, like I said, the purchasing, it would be the purchasing orders. So I'm going to come up with a base for each one. If 2 different activities actually have the same thing driving them, they could be lumped together. Then I'm going to come up with a predetermined overhead rate for each activity, and then I'm going to allocate it based on those. So in this example that it uses in the chapter, they break their production process into 3 different activities. So that's the first step, and I estimate which costs are associated with each of those. So there's step 1. Step 2 is to allocate a base for each one. And again, I have to do this for each activity that I've identified. If I'm going to have 20 activities, then I have to identify 20 different activity bases. And so I'll pick those. And again, you have to know the business, right? You have to know what you're doing and what's driving these costs. If you pick a cost driver that's not related to that or not driving that cost, you're still going to get a number. It's just not going to be a meaningful number, and you're not really going to be anticipating your costs or allocating them accurately. Step 3 then comes up with a predetermined overhead rate for each activity. So in this case, I'd be doing that 3 times because I have 3 different activities. And this is the same way it is. Total estimated cost divided by the number of hours or the number of miles or the number of purchase orders or whatever I'm anticipating. And then step 4 is I'm actually going to allocate these. So I have a standard product and a premium product. This is the same one we've been doing. So set up, I came up with a predetermined overhead rate of $250 per batch. I did 40 batches, so I allocated 10,000 costs. For production, I came up with $520 per direct labor hour. I incurred 10,000 direct labor hours, so that's 52,000. And so you can see here's what I came up with for my overhead costs, my total overhead cost per unit. Here's the total overhead divided by 2,000 units, total overhead divided by 500 units, and so I've got now 45 and 38.75. Now if I compare that to what I had before, when I just did a single plant-wide allocation rate, I just took, here's my overhead, I divided by the number of units, I had 273 for the standard model. When I broke that up into I don't know what they were, assembly and something else in there, that cost went up to 275. When I do activity-based, which is right here, that goes all the way down. And again, the direct cost and direct labor are the same in all of these. It's this overhead cost that's changing. And so it goes up. And so now it goes up even further when I do activity-based. And this is going to be your most accurate number. So you can see you were underestimating your cost by a good bit by using the plant-wide rate. If we look at the same thing with the premium, when we used a single plant-wide rate, we thought it was 59. It went down to 51. When I split that up, it went all the way down to 45. So this product is actually much cheaper to produce than I thought it was, because I was allocating too much overhead to this job and not enough to the other one. And so that brings the price down even more, which is obviously going to increase the contribution. And so if you take this back to your Chapter 21 stuff, if you have a limited amount of time, you want to spend your time making the one where you make the most contribution per unit, and so you need to know what that contribution per unit is. And you've got this, your variable cost, but you're going to make more profit on this one, so you need to factor that in there. So let's just look at something here where we're going to compare traditional with ABC costing. So if we use, and I think I kind of cut off part of the problem here, but you can look in my lab for that one if you want. So the first thing we're going to do is calculate what my overhead's going to be if I'm using a single plant-wide rate and I'm using direct labor hours as my allocation base. And so I have a low gain and a high gain antenna. So the first thing I come up with is my overall rate. So my budgeted overhead is $88,000 is my total overhead, and I'm anticipating a total of 5,000 direct labor hours. So I come up with a rate of $17.60 per direct labor hour, like that. For my low gain speakers, I have 1,200 hours. That's right here. And oops, that's an extra zero. That makes a difference. 1,200 hours times 1760 is my overhead rate, which means 21,120 is the total overhead I'm applying to that job, and I am making 125 antennas. So my manufacturing overhead cost is $168.96 per unit. That's how much overhead I've allocated to each unit of the low gain. The high gain, I've got 3,800 hours. I'm going to use that same rate right here of $17.60. So that's $66,880 of overhead I'm adding to those. Divided by 225 high gain antennas equals $297.24 per unit is the amount of overhead I'm adding to that. If we split that, the second part of the thing says you split that into setup and maintenance as two different activity bases here. So for setup, my overhead is $58,000. Oops, I keep doing that. And in the problem, that the part that got cut off here, it says that they are using setups, number of setups in their number of setups as the cost driver over here. So there's a total of 80 setups. So if I take 58,000 divided by 80, I get $725 per setup is my allocation base for that. For maintenance, my total cost is $30,000 is the total overhead, and I'm using machine hours as my base, and over here I'm anticipating 5,000 machine hours. So I get an allocation rate of $6 per machine hour over here. So my low gain, my setup, I'm going to apply $725 per setup, and I had 40 setups right here. So that is $29,000. And The maintenance, I'm going to do $6 per machine hour, and I had 3,000 machine hours, so that is $18,000. So that's a total of $47,000 that I allocated there, divided by 125 units, gives me 376 per unit. For the high gain, I am going to take setups would be $725 per setup, and I did 40 setups, so that is $29,000. For maintenance, it's $6 per machine hour, and I had 2,000 machine hours, so that is $12,000. Darn it. 12,000. So that's a total of $41,000 in overhead, and that's 225 units. So that is $182.22 per unit. What I did on the last problem for the single plant-wide rate, I came up with $168.96 for the lo-fi and $297.24 for the high gain. Sorry, high gain, low gain. So I can see this one is actually much lower cost than I anticipated, and this one is significantly higher. So I was way off with how to apply those. And again, you could do the same process with the ABC costing and see how much different that would be. The more detailed you get, the more departments you break it into, or activities you break it into, the more accurate your number is going to be. So I'm going to cut this off here and then come back and do the rest of the chapter in a second video.